All right, we've done our adjusting entries. We put those together, and we can move on to the financial statements. But before, again, we can dive straight into that, we have to still abide the usual steps we have before we get to the financial statements, which is first, we have to do a trial balance. Again, we're just checking to make debits equal credits, and of course, as you observe down here, they indeed equal each other. So we've checked that off. As far as some of the numbers you're looking at, they're not real consistent with necessarily what you've seen in the previous November example for this company. Again, this is now December. So some of these numbers you're going to look at and go, where did that come from? I just made it up. So I just have to treat it as such. Now, some of these, they do dovetail. They're consistent with numbers that were described earlier, such as like this balance in notes receivable, because we mentioned that we loaned the company $150,000. So there's where that came from. And of course, the balances in these accounts here came from the deferrals when we talked about that, purchase of supplies, prepaid rent, prepaid insurance that were paid for. The trucks account is, of course, equal to the 250 that we started with in November. We bought 10 trucks, added a truck, so 275. The unearned fees account, again, we listed out like that we took $20,000 in advance. And of course, the original $1 million in stock that was, that was issued, the 50,000 shares for $1 million, that's of course consistent. And then the ending balance retained earnings for the end of November is consistent with that example as well. Otherwise, again, the rest of those you really can't read much into, right? So we've checked step 4, debits due equal credits. So now we have this middle set of columns is just saying, okay, now we've done our adjusting entries, right? We've journalized and posted those. So that's step 5. And then just once again saying, do debits equal credits? So what you're going to note here is the impact of these adjustments on various accounts. Now, obviously, it's not impacting everything, and the impact can either be one of two things. There's only two possibilities. It's either going to increase the balance in that account, or it's going to decrease it. There's really no other possibility there, one or the other. So we'll just step through them here. So first we got accounts receivable, and was debited for an additional $17,500, because again, we had to accrue that $17,500 from the job that was completed. So that's why you'll see the balance in AR increase to $68,500. Now, as for these next 3, supplies, prepaid rent, and prepaid insurance, those were all reflections of amounts that were used up. So every one of these is consistent in that it's a subtraction in the account. So in other words, we go down from $5,000 to only $500 for supplies. Prepaid rent goes from $30,000 to $20,000, and then prepaid insurance goes down from $6,000 to $5,000. Similar thing happens in the accounts payable. Ooh, pardon me, I'm getting ahead of myself there. I had unearned fees in my brain already. I'm like, nope, not yet. Next up is accounts payable. Now that's one that's going to be an increase. So we add $6,500. That was for the utility, so that goes up to $26,500. This is the one I was starting to think about. Remember, we earned $14,000 of that $20,000 we took in advance. So that's why you'll observe that one went down. So that was the case with our deferred expenses and our deferred revenue accounts. All of those, the accounts that were on the balance sheet, were all declined. All the prepaids we had, including supplies, and then of course this unearned account. All right, what's up next? We see fees earned was increased $31,500. I know that number doesn't appear anywhere, but if you take this plus this number there, yep, that's where it's coming from. That's how it reconciles. So that will equal $31,500 increase, of course, in fees earned. So now it's up to $186,500. Utilities expense was increased $6,500 because, again, it was incurred but not yet paid. And then wages expense, same thing, incurred but not yet paid. So we add that $57.50 to that. So that's now $48,875. Okay, so that takes care of the accounts that had an existing balance and something maybe was updated. Everything below here, this is just sort of the, accounts that had no balance but were included in the adjustment process. So these take care of themselves easy enough. Like all the other ones we didn't touch up in the first half of this, like cash, trucks and so on. Whatever their balance was just gets forwarded to the adjusted trial balance columns. The same thing is going to be true for all these numbers here. Whatever you're seeing here is just going to be true in the next set of columns over. All right, so again, obviously the adjusting entries all balance. And then once again, the adjusted trial balance is just saying, hey, just check to make sure to all of those accounts still balance. Because again, we're still at the mercy of the potential of a system where you can post debits and credits out of balance. So because of that, we're still checking this stuff. Eventually, someday, I imagine this is going to go away, but we're just not there yet. So we still have everything in balance, so right down there. Everything checks out. Okay, so now once you've gotten to that step, so that's step 6. So just to repeat them, step 4 was the initial trial balance, which we could label the unadjusted, although it doesn't have that label expressly. Step 5 was to do our adjusting entries. And then step 6 was the adjusted trial balance. So now we're working on step 7. So step 7 is actually doing the financial statements. Now, before I go over there, I'm just going to get rid of some of this noise in here. So that'll just make it easier because there's some points to be made. I'll clean all that out there. All right, so we're going to go to the financial statements. Now, the adjusted trial balance is your source document for your financial statements, and we're still doing them in the same order as before. Income statement, statement of retained earnings, balance sheet, 1, 2, 3, like that. Okay, so what do we need for the income statement? Well, we need revenues and expenses. So again, what are our revenues here? In this case, continue to get rid of some of these lines that I've drawn in here. I should just give you one giant eraser for all this so you could just go zoop, done. That is not an option though. All right, so let's just clean all that garbage off of there as much as possible. Great. All right, so what are our revenues here? So we had fees earned, so that was $186.5 after adjustment, and of course we added a new revenue, interest revenue of $1,500. So when we get to the revenues, you'll see two things there, and again, same semantics as before: name of the company, name of the statement, and then in this case, and then as it is true for the income statement and statement of retained earnings, for month ended, a period of time is described. In this case, December 31st, 2019. So there's our two revenues we have, and they total $188,000, like so. And then we still have to track down our expenses. Well, that turns out to be pretty easy here. Kind of a happy accident, because they all, almost forgot depreciation, they all block out right there nice and neat. So that's all your expense amounts right there. Ooh, that got a little bigger than I imagined that one. The mouse hand does what the mouse hand wants sometimes. Just out of control. All right, so all of those are listed there. And again, how do you list them out on the income statement? You know, again, alphabetical would be fine with me, except, of course, what? Miscellaneous should be last. In this case, I said, okay, our wages is our largest one, so we'll start there. But you'll notice it doesn't really continue the pattern of going from largest to smallest. It just kind of jumps around. And obviously, of course, we wouldn't put insurance last because, again, miscellaneous is the catch-all, so that one should always just be dead last. But so we have our total expenses here, $91,250, which results in our income of $96,750. I will remove a little bit of that there, just so that you can clearly see what the income is. And same as before, that's going to become an element on the statement of retained earnings. So same semantic there, name of the company, statement of retained earnings, and for month ended December 31st, 2019. Now, of course, in this case, we have a continuation from a previous month, so we have a beginning balance now, $32,500, which you'll observe there. And of course, same as before, we add our net income, $96,750. There's our subtotal. Did we have any dividends? Yes, we did. 30,000 of those. So subtract that 30,000, so 99,250. I didn't list dividends as being subtracted. I just worked with the notion that everyone who's watching this knows they need to be subtracted, so you understand the interpretation is dividends should be subtracted from the 129,250. That's just the way it works. Okay, so that's our ending retained earnings balance, so December 31st, 2019, and then we move on to the balance sheet. Remember, this is a classified balance sheet you're looking at here. That means we're classifying according to, you know, in the assets section, current assets first, and then if we had them, long-term investments, then fixed assets, then intangibles. And then the liability section, the classification should be current liabilities, long-term liabilities. In this example, you will not see any long-term liabilities, but that's how it would go if we did. Right, so our semantic is for this one, company name, balance sheet, and remember, for balance sheets, it's just a point in time we're reporting at because we're just dealing with the accounting equation. That's the way the accounting equation is structured, just reports what's true at a point in time. That's why it just says December 31st, 2019. Right, so our assets should start with current assets. So what constitutes current assets is pretty much everything from here to here, and then you'll notice, yes, we added one in the adjustment process. We added interest receivable. So all the numbers from here to here will go in that section, plus an additional 1,500. Oops, I'll make that visible now so it's not just a big smudge. There we go, $1,500. That's a little better, I guess. So that's all you're looking at right here is all those listed out. And I just listed them in that order because, again, there is the concept of liquidity backing them, but the thing to keep in mind is our only real liquid assets here are cash AR, and the note itself. Everything else here, I mean, these are all going to end up being an expense, and this one just exists because of the timing discrepancy between, when we need to recognize the revenue versus when the note comes due. So not really any liquidity at all in any of those. So that's why you can't argue the first three, and after that, it really kind of doesn't matter, except that I put interest receivable at the bottom simply because it was sort of, just say it was late to the party, so to speak. All right, so that's our total current assets right here. And then as far as any other asset class, all we had was trucks. So again, we know that balance is right there at the 275. I'll bring that out into the light there. There we go. So we got our 275 here. And then what's our balance in accumulated depreciation? That's the account that was more or less added from the adjustment process, 3125. So that's what we're just showing here, is the trucks less that accumulated depreciation gives us total fixed assets of this. And then let's get rid of the bottom of that. And that, of course, results in total assets of there, 1,137,500. All we're left with now is our liabilities and shareholder equity. And this gets a lot simpler now, because again, the liability section is just going to consist of what? Accounts payable, unearned fees, and what else did we add? We added wages payable because of the adjustment process. So those amounts there, so that's going to be the 26,500 plus the 6,000, and then the additional $5,750. So that's all you're going to see here. And again, they're all current, so that's just the three. So we just say total liabilities, that's found, 38,250. All we're left with is whatever the balance in our common stock was. That's the $1 million, pretty much from the beginning of the original example, our million there. And then, of course, the only place this 99,250 exists is on that financial statement, the retained earnings statement. It doesn't exist anywhere else. If we looked up the balance in the ledger, what would we see? 32,500, the beginning balance, because there's something we still have to do there. Again, I've said this many times in these videos. Why is my coordination with us not getting better? I have no idea. 32,500. Don't believe it when they say if you do something enough, you'll get good at it. Not necessarily. Yeah, not always. Most of the time, that's true. Not necessarily. All right, so anyways, almost done here. So we got, add that 99,250 to all our other numbers, and we get the same 1,137,500 as you would expect, of course. So that takes us to the end of the seventh step, which is to prepare the financial statements. Next up after this, you should continue to the video that's going to deal with the closing entries and the post-closing trial balance, which will round out and end the accounting cycle. So I'll see you there.